Hey everyone, ServiceNow, a provider of cloud-based services that automate enterprise operations, is finding its stock price dipping. It's down over 17% off its highs, and investors are curious if ServiceNow stock is a buy right now. Of course, this workflow automation process competes with UiPath, which in the last week or so reported disappointing results, downgraded its profit outlook, and replaced the CEO after an abrupt resignation. So that's not helping investors looking at ServiceNow after they saw what happened to UiPath, which is another automation company. So I'll review ServiceNow and I'll answer if I think the stock is a buy at current valuations.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So looking at ServiceNow's 3-year stock price chart, it's now 19.61% off its all-time high. Although the company was recovering nicely from its mid-2022 lows, the recent reports out of UiPath and the decelerating revenue growth rate at ServiceNow are somewhat spooking investors out of this industry and this stock in particular. Now, in the latest quarter, the company's top-line revenue did exceed guidance. The company's revenue of $2.6 billion in Q1 2024 represented 24% year-over-year growth. Investors would be happy with over 20% growth from ServiceNow longer term. But one of the areas that was a little bit concerning was the current remaining performance obligations increased by only 21%, signaling that revenue growth might be decelerating for ServiceNow. Of course, remaining performance obligations eventually turn into revenue. So if RPO is growing slower than revenue, that means future revenue is likely to be slowing down. But longer term, remaining performance obligations performed relatively well, growing faster than the current remaining performance obligations. So it was a bit of a mixed bag from ServiceNow in its latest quarterly report. Of course, ServiceNow reported these results on April 24th, which was roughly a month before UiPath reported results, and UiPath's results were much worse than ServiceNow, especially the operating income downgrade. UiPath slashed in half its operating profit expectations for the current fiscal year and brought down several participants in the industry. Additionally, competition is increasing from giants like Microsoft and Amazon that are beginning to offer their own automation services in their cloud segment. So this industry has been hit with some decreasing investor sentiment, and the stock prices have taken a hit. So undoubtedly, one of the reasons why investors are interested in ServiceNow stock is because of its relationship with NVIDIA and Hugging Face, where they recently released StarCoder 2, a family of large language models for code generation. In an expanded partnership with NVIDIA, ServiceNow also became one of the first providers to access NVIDIA NIM inferencing microservices for large language model development. And as has been the case with companies making deals or signing agreements or having relationships with NVIDIA, they benefit from the halo effect because NVIDIA stock is so hot and NVIDIA's profits and revenue are soaring so explosively. It seems like every company that becomes associated with NVIDIA benefits from that halo effect. It increases investor interest, and sometimes it causes a boost in the share price, although there's a lot of volatility associated with those boosts that come with the halo effect from the associations with NVIDIA. And several cases of this, you could look at companies like SoundHound AI, ARM, Supermicro Computer, Dell, all of which experienced increasing investor interest, increasing short-term price, but increasing volatility as well. As you've noticed from all of those companies I mentioned earlier, their stock prices have been more volatile than usual following their relationships with NVIDIA. So, like I mentioned earlier in the video, the remaining performance obligations came in at an increase of 26%, which was faster than its revenue growth of 24% and much faster than the current remaining performance obligations of just 21%. What's more, ServiceNow has $17.7 billion in remaining performance obligations, and at its current pace, this is roughly a year and 3/4 worth of revenue in backlogs the company has attracted. Furthermore, ServiceNow is doing an excellent job increasing its profit margin and cash flow. Let me share those statistics with you as well. So if you consider ServiceNow's cash flow from operations to sales in the trailing 12-month period, and we go back a decade, you can see this metric increasing nicely, 40.48% in the most recent trailing 12 months. That's up from less than 24% in 2015. The company is doing an excellent job in increasing this metric while revenues have been increasing. However, its operating profit margin is improving significantly up to 10.02%, up from negative 24% in 2015. You can see the big difference at 10% versus 40% in operating profit margin to cash flow from operations. And the reason for that is ServiceNow uses a significant sum of stock-based compensation, which is a non-cash expense that dilutes shareholders. It's impacting the operating profit margin, but it doesn't impact the cash flow from operations as much because it's a non-cash expense. So the company has been buying back some of their shares, spending close to $200 million on that task, but it's still diluting shareholders to some degree. But the company is making great progress in its profit margin and cash flow from operations as its revenues have increased over the last decade. And you can see revenue here in the trailing 12-month period, $9.478 billion, up from less than $1.25 billion in 2015. So nearly 7-8x growth in revenue in that time. And as I've been saying with UiPath, these services, these automated services, are more in demand nowadays because of the rising cost of labor and the difficulty in attracting talent. You can increase your effectiveness of your business by utilizing these services and at the same time improve your customer value proposition, because if you can automate these tasks, you can complete them faster at times and more effectively at times compared to humans doing these same routine tasks like processing accounts receivable and accounts payable, processing insurance claims, things that are repetitive in nature that take longer to process for a human than a computer can do, than a process can do. And so there's a huge need for these services. As labor costs are increasing, the need for these services increase even more. So I've liked the industry. I've recommended UiPath stock as a buy, and trading at a forward price to earnings of 40.19, ServiceNow trades at a relatively fair valuation given its metrics, given its profile, given the improving cash flow from operations, given the operating profit margin. So if I was to answer the if I was to answer the question, I should say, is ServiceNow stock a buy, hold, or a sell? I would say the stock is a buy, and I'm making that recommendation today on June 3rd. I like the progress in profit, in cash flow, and revenue growth, and it's all trading at a relatively fair valuation. So I think ServiceNow is an excellent stock to buy at current valuations. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.